Well, it's a great day. I'm Dean Jones, President and CEO of Realogic, Sotheby's International Realty, on location in our Kirkland flagship office on the east side of the Seattle metro area. And I am here with Jonathan Woloshin, UBS Wealth Management. Jonathan, welcome. We're so pleased to have you.
Pleased to be here.
I am thrilled that you're here. I mean, we feel like we're at this inflection point in the market. We're here for our Market Maker event. You're about to address our audience. I know there's going to be lots of questions. You've got lots of data to share. But first, a bit of a question about UBS Wealth Management, your background, and sort of what representation do you have in terms of the worldview of investment relative to your clients and the data points that you have access?
So I've been with UBS now for 17 years. I work in the group called the Chief Investment Office, which think about it as the research arm that is solely dedicated to our individual investors and our financial advisors. I'm celebrating my 40th anniversary in the industry this year.
Fabulous.
As I like to say, I'm a reformed investment banker. I did that for 6 years, and I've been an analyst for the past 34. My focus at UBS is in the real estate world. I'm responsible for all the U.S. real estate research, both commercial and residential and lodging.
You have a viewpoint that sometimes gets ahead of the headlines and really knee deep in the trend lines. And I mean, what sort of data points do you get from your actual clients?
Yeah, and that's one of the great things about the seat that we sit in, because we work so closely with our clients and our advisors, and they know that they can trust us because we will never betray a confidence. Sure. We get some great real-time, on-the-ground information, whether it's from our clients who own commercial real estate, they're in the residential real estate business, be it on the brokerage side, the home building side. I just presented to a group that buys hotels for a living, and I got to spend 2 hours with them. So we're really getting truly ground level operating data, not with a public company spin on it, but they're telling us what's going on and we're sharing information with each other.
And if you look at sort of those investment holdings, might be a strip mall or a hotel or a small portfolio of apartment buildings, I mean, what percentage of that industry would you say is owned by individual investors that might be a client of yours, as opposed to a REIT?
The vast majority of commercial real estate is still owned privately. Now, certainly over time, and these are round numbers, say 15 to 20% of commercial real estate, at least here in the U.S., is owned by the public companies and the balance is private. I think the biggest shift we've seen over the last 20 years is on the private side. You've seen much more money raised by the large, very large institutions, be it the Blackstones of the world.
Wow. And you're working with them.
Oh, absolutely.
Blackstone,
Yes,
that's a big one. There'll be a large transfer of wealth in the next 10 years. And you think about the amount of real estate that's part of the family office. I mean, what sort of predictions or data points would you share with our audience about just how much money could trade hands in the family, how much commercial real estate might make its way into maybe residential?
Yeah, so I mean, the numbers are certainly in the multiple billions of dollars in terms of intergenerational transfer of wealth. I think the thing that makes it interesting and challenging is when we start talking about, they call it G2, G3, G4, G being for generation. We found with a lot of our clients, as we get to G3 and G4, a lot of them are not interested in being in the real estate business. And so this is starting to involve some very, very careful and sophisticated and long-term tax planning about what to do with real estate, particularly on the commercial side where the basis is sometimes zero or negative. And so those are some interesting conversations that we're having. In some cases, G3 and G4 will take over the business. But that's one of the biggest trends that we see, at least on the commercial side, is how can we structure ourselves tax efficiently? And if we don't, and if our younger generations do not want to take over the business, how do we move forward? The implications are, if there is a tax efficient way to realize funds, that money is going to find its way elsewhere. Right. Whether it's in residential real estate or other parts of the economy.
It's a significant amount of wealth transfer. I mean, as the saying goes, some folks out there say, well, my kids they're waiters. And they're like, well, what do you mean? They're in the hospitality, the restaurant business? No, they're waiting. They're waiting for the massive transfer of wealth or the PhDs, A lot of kids have PhDs. Their papa has dough. Right. So
I hadn't heard that one. I like that one. Yeah. Well, neither of my kids have a PhD. I'll leave it at that.
Well, I got to work hard for it.
Yeah. Well, that's how I was brought up. So that's how they were brought up. I mean, look, every family is different. One of the things UBS runs is something called the Young Successors Program, where what they will bring in the G3 and G4 of these very wealthy families. And it's basically financial boot camp, where they teach them, and literally it's finance 101, is what is a stock, what is a bond? Because in many cases, these younger generations understand there's wealth, but don't really understand the depth of that wealth. And so that is a very good program. And the other thing is to keep in mind that, I said I've been doing this for 40 years, so we can do the math how old I am. Younger people are comfortable working with people their own age. And so I think it's not only important to educate them, but to make sure that we have the people, and when I say we, not just UBS, our industry, have the people who can talk their language and understand them.
What do you think for 2024 here? I mean, are we going to see a recession or a soft landing? I mean, what's the kind of prognosis?
Yeah, so our house view call is we are going to see a slowing economy each quarter. We are not calling for a recession. We have certainly dialed back our view on the number of rate cuts and when they will come, because the data has been coming in stronger. Now, we will get a jobs report this Friday, and while I don't think too much should rest on any one report, the jobs report certainly can be a market-moving event. But we can certainly see slowing economy, a softish landing, and in terms of rate cuts, I mean, I have heard the case for zero rate cuts. That is not our house view call.
Don't say that.
No. But I'm just saying it's out there. We've heard some very high-profile people say the Fed should not cut. We still believe the Fed will cut at least 2 times, but they are going to be data-dependent, and they've been very, very clear about being data-dependent. We had the ISM services number that came out today, which on the whole was weaker than expected. The bonds are not moving too much on that, because I think everybody's kind of waiting for the employment report. But if we get a couple of months in a row of softer than expected employment report, and I think if we look at inflation and the way inflation is measured, especially CPI, we think there are some real flaws with the major component, which is shelter, that we could see inflation moving towards the Fed target. Whether it actually gets to 2, maybe on a run rate basis it will, but the question that we ask ourselves is, does the Fed have to see 2, or do they have to see the trajectory to 2?
Let's face it, if shelter is part of the CPI, I mean, we're seeing median home prices rising. S&P Case-Shiller will be reporting on most recent data now. All 20 cities are, year over year increases. I don't see any recipe for a falling knife in home prices. We're undersupplied. There's lots of equity. There's not a lot of distress out there. How do you feel the housing market will be impacted by this kind of soft landing if the Fed is, not cutting rates as quickly as they might have, been indicating last year?
Yeah, and so look, our view is, and we've been very, very consistent in this view for the last several years. This is not a repeat of 2008, 2009, and we've heard that from many, many sources. We're in another housing bubble, and people are confusing the fact that home prices are, for many markets, at or near all-time highs, with we're in a bubble. The structure of the housing market is drastically different than it was in 2006 and 2007. Whether that is a complete lack of inventory, much better underwriting standards, the amount of equity people are sitting on, the fact that the vast majority of mortgages are fixed rate. Of the round numbers, 84 million single-family homes in the country, say 30 to 40% are mortgage free. Of the balance of the homes, 62% have a rate below 4%. So people are, and there's $30 trillion in equity. So we think the structure of the housing market is much better. Now, for those who want to buy, with rates being elevated, it's certainly a challenge, but it's that dearth of inventory that we think is certainly going to help offset any decline. Now, that said, can home prices decline from peaks? We've seen it in some markets, whether it's San Francisco, whether it's Austin, Texas, whether it's in Oakland. Now, we have different drivers, and some of these are very, very city specific. Whereas you look here in King County, you're at an all-time high in prices in King County now. Yeah. So, I mean, there are definite local drivers, and as you well know, this is a hyper-local business. Yes. But unless mortgage rates really move up significantly from here, and that is not our call, because we're sitting here round number 7% of the 30-year fixed, right. And the spread between the 10-year Treasury and 30-year fixed is much wider than history. So if we do get clarity from the Fed on rates and some stability in rates, we think that spread will come in. So we don't think mortgage rates will go back to that 8% level. Right. Now, if they do, that will certainly be a bigger challenge for the housing market. But at this level, We think people are starting to get their arms around. We're going to be in a high, we're back to a normalized rate environment.
Well, and I think that new normal is okay and people can move forward with confidence. What's your view of this? I mean, a temporary imposition of a higher or elevated mortgage rate versus the fact that in some of our submarkets, median home prices are rising like 50 basis points a month. So you got maybe a year or two of elevated rates, then you refi, that buy then refi strategy. I mean, I think if you wait around too long, you might find less selection and higher prices. And where does that factor in with, strategy for someone waiting for a lower rate? Lower rate just means there's going to be more buyers competing for the same home. So, what's your view about that? And what are sort of the impacts of developers? I mean, why aren't we just building more housing if there is so much demand?
A lot to unpack there. And we have this conversation with clients a lot. Is this a good time to buy a house? Should I buy the house? And so what I do when I talk to clients is I go back to them and I ask them 5 questions. And I say, don't answer them for me, answer them for you. And those questions are, why are you buying this? Are you buying it for shelter? Are you buying it for an investment? Are you buying it for a flip? Question number 2 is, what is your anticipated time horizon? Understanding that life happens. But what's your anticipated time horizon? Number 3, what are your near-term, mid-term, and long-term liquidity needs? Number 4, is buying this house going to drastically change your lifestyle? And number 5, and there's no magic to this 20% number, but it's big enough to get people's attention. If we're to drop 20% in value, would that change your lifestyle? And the reason I asked them to think about these questions, so if somebody comes back and says, I'm buying this for shelter, I believe I'm going to be in this home for 5 to 10 plus years. Again, understanding life happens. Right. I have the liquidity. It puts a little strain on me, but it's not going to change my lifestyle. And given my time horizon, no, I'll deal with it. Then timing markets is a fool's errand. Any of our financial advisors would tell you, timing the stock market is a fool's errand. Well, it's even harder in the real estate business. And so, look, this is an extraordinarily emotional purchase. And for most of us, it's the largest purchase we'll ever make. So I think that is the value of having good advisors and a realtor. A good realtor can bring a lot of help there in helping take the emotion out of an immensely emotional decision. And so from that perspective, up until 2007, I guess, home prices never went down. Now that we've seen home prices can go down. And so people are always worried about that. But then I always go back to, go ask those 5 questions. It's like, the Karate Kid Part 2. Rule number 1, karate for defense only. Rule number 2, go back to rule number 1. Right. And that's what I always say. When in doubt, go back to rule number 1, which is, why did I do this? And do those, those 5 questions. Are those still intact? If they are, go forward.
Well, and it's probably a decent, financial safe harbor, and it is a lifestyle investment. I mean, it is, you can't live in a stock, right? You can't live in cryptocurrency, but you can live in a home. And as I look at the demographics, I would imagine quite a few of our clientele will be thinking about selling a home in the next 5 or 8 years. They're looking at retirement, maybe a golden parachute, and getting a second home in another destination market. The kids have moved out. They've had 5 bedrooms that haven't been slept in many, many years. We notice that folks are living and lingering longer in their homes.
Clearly, yes.
But eventually they're going to let go. And, if I kind of line up their lifestyle goals, and you have many of these clients that are probably huge equity positions in these single family homes, likely to let go in the near future, how does capital gains tax planning play into that? And do you have any concern about the upcoming elections, our debt ceiling, all the policies that go around our capital gains tax rate?
Let me start with the last point about, I presume you're referring to the debt and the deficit federally. I was asked this question, it's got to be 14 years ago now, because I remember President Obama was in office, and I was asked, at that time the national debt was $10 trillion, it's now 34 trillion. And I was asked the question, when did his debt and deficit matter? And I will give the same answer today I gave 14 years ago, and you're not going to like the answer, but it's a very honest one. It doesn't matter until it matters. And I don't know that anybody can tell you when it will matter. Right. But as long as there are investors and governments willing to buy our debt, unfortunately, the federal government will run federal deficits, and the debt will go up. Because there are very few things that are bipartisan in Washington, but one of them is spending. And that's just an unfortunate reality. So that is one of the reasons we don't think we're going back to a zero interest rate environment.
Right.
And we think people, and I'll say it bluntly, because it was said to me in a meeting I did not too long ago, this is where rates are, get over it. So look, whether the 10-year ends the year at 4%, 3.5%, 4.5%, I will tell you that everybody's been wrong on rates. Our base case is somewhere between 3.75 and 4.25, but I think any forecast should be taken with the appropriate degree of skepticism. But, in terms of people staying in the homes, you're right. If you go back 15, 20 years ago, the average duration in a home was 7 years. Now it's something like 12 or 13. But eventually, yes, those people will move, and they are equity rich. Many of them are mortgage free. And so that will enable them to go out and be cash buyers. In terms of capital gains tax policy, look, for me, everybody's political views should be respected, whatever they are. For me, when I think of politics, I think of policy, and policy is what matters. And so I just listen very carefully what both sides of the aisle say. And the short answer is that, the Democrats clearly are more interested in raising taxes than the Republicans. That's just factual. I mean, look here in the state of Washington, they instituted a capital gains tax, which I know they're looking to put a repeal on the ballot in November. But it's raised, I think, $900 million since.
But we lost Bezos out of it.
Right. And so, but what I like to say is, in President Obama, he said elections have consequences. Well, I like to say his policy has consequences. And you can go back to the state of Oregon. I think it was in 2016 when they put a millionaire surcharge tax in. 80 millionaires left the state. I mean, one of the issues is politicians tend to think statically. Regular people think dynamically. Right. And so there is going to be an impact. And these are just realities. Now, if we have a situation where there is a Democrat clean sweep, and we're not predicting that, but I'm saying if, the odds of taxes going up are higher. Be the marginal income tax rates, be them capital gains tax rates, what have you. So I think it will depend. At the state level, certainly one of the big considerations, especially for very, very wealthy families, is estate planning. So thinking about where the state taxes are. Somebody once said to me, and no disrespect to the state of Washington, you want to live in the state of Washington, but you want to die in Florida. Yeah, and so these are all, and one of the things I focus on, and Dean, you and I have done some work before, I talk a lot about the forces driving migratory patterns of people and businesses, and one of those is policy. And so I think these are the things that the balancing act for cities and states is how do we balance our budgets and our needs against the policy impacts. And it's a challenge. I don't say it's easy. I mean, a perfect example, the state of Illinois is in very, very poor shape financially, as is the city of Chicago. Well, they just tried to implement a version of the mansion tax the city of LA did, and it was voted down. Yeah. I think so. At some point, there has to be this come to Jesus moment for politicians to say, yeah, how do we balance these two things? But very easy for me to say sitting in this chair. I'm not running for office.
So, Jonathan, I have to ask, with the potential repeal of our statewide capital gains tax for non-real estate, so securities primarily. I mean, that was a form of income tax, which is statutorily not supposed to be happening in the state of Washington. And, everyone did notice who has left and taken up residency in other states. And, that is a form of capital flight. We watched the city of Seattle with all their efforts to impose a head tax. You saw what Amazon did, with HQ2, which, in some ways also feels like 425, our area code here on the east side. I mean, millions of square feet of office has, moved this direction. But, will there be an immediate impact in the housing market depending on the outcome of this presidential election? I mean, if you say a Democrat clean sweep could likely indicate future tax increases, capital gains, estate taxes, et cetera, would there be a potential rush to the counter to go ahead and unload real estate before taxation, or will it just get priced in overall and back to normal?
Look, I think the answer is it depends on what will happen. President Biden has talked about a higher corporate tax rate nationally. So I don't think that in and of itself is going to get somebody to move. A lot of it's going to be what happens at the local policy. If we do, and I'm not saying this is what's being proposed, but if they do, move the capital gains rate to the marginal tax rate. That's obviously going to have very, very big implications, not only for values, but transaction velocity, which will make price discovery very, very difficult. But I know President Biden has also talked a lot about various housing initiatives to help housing affordability. You did pass housing density here in the state of Washington.
House Bill 1110.
Yeah, and so the balancing act here again is how do we get affordable housing without killing housing values in certain areas. Now, having read through 1110, and I have not read every word in the bill.
Yeah, we'll be talking about it today.
Yeah, but it's based on city size. It's based on proximity to transit corridors. But look, this is something that is going to have to be addressed irrespective of who sits in the White House and who sits in Congress. But the realities are, and this is something that I know, whether it's the National Association of Realtors, the National Multi-Housing Council, have talked about the regulatory costs of building account for something between 30 to 40% of the cost of building a home or an apartment. And when I talk about policy, these are the things that politicians don't want to talk about. But if we're going to truly have an affordable housing market, we're going to have more housing density, you have to give incentives. You can't, if we talk about carrot versus stick, the stick's not going to work because at the end of the day, development is risky. And developers need to earn a reasonable risk-adjusted return on their investment.
There's a lot of headwinds for development, though. It's the land cost hasn't gone down. Obviously, labor, supply chain, regulatory considerations, interest rates. All of this is adding up to a higher cost of delivering replacement housing. And around here we have the Growth Management Act. We've got lots of tunnels and bridges and waterways and mountains, and we can only go up, in residential density, in my opinion. And there's a lot of headwinds to that because the world can change a lot in 5 years, as we've learned. And we've seen a pretty dramatic slowdown on groundbreakings for both rental and especially for condominium development. And these are the more affordable product types.
Yeah.
And House Bill 1110, maybe we'll get a bunch of ADUs and DADUs in the backyards of your neighbor's property, but that could take many, many years. I heard one analysis from a local economist, Matthew Gardner, had said in Minneapolis they had a similar bill. And it only delivered about 2,000 or 3,000 housing units. So it's not much different than 2 or 3 large apartment communities. And so it's just maybe too little, too late to get a high volume of a more attainable housing.
Yeah, and again, this goes back to static versus dynamic thinking. And I remember when Governor Newsom in California a couple of years ago signed a number of housing density bills, thinking, we're going to build all of this. And, and immediately you start to get pushback. And where did the pushback come from? Very, very high-end communities, Atherton, California, Beverly Hills, Hillsborough. Because at the end of the day, irrespective of one's political affiliation, they were like, I've got a lot of money into this house and I don't want this.
Not my backyard.
You're seeing it in Massachusetts as well. You're seeing it in a lot of places. And so while these may be well-intentioned policies, the realities are that development takes a lot of time in the best of circumstances. And when you try to impose policy that is not necessarily aligned with economics, it will take even longer. In my view, all this adds up to, short of a very, very severe recession, I think in markets like up here in the Seattle, Bellevue area, with limited ability to build new inventory, you're likely to continue to see elevated home prices. Could they dip from their peak levels? Of course they could. Certainly. One of the things we have to keep in mind is, the number of tech jobs has declined here. And I think we're going to continue to see right sizing of businesses as businesses become more efficient. I think people are still grappling with what alternative intelligence, AI, means for the long term and how that will impact businesses. I've read a lot of different analyses, but frankly, I think a lot of people don't know. But the bottom line here is it's still a beautiful place to live here. It is for the moment, an income tax-free state, and we hope it stays that way. Yes. But, we've seen over the last 10 years a lot of migration from Western Washington to Eastern Washington.
Well, they're driving to affordability, or they're, stay at home, hybrid work weeks. You'll meet a developer here today that's got a very significant 1,000-unit master plan community, only 90 minutes east on I-90. And with all the expansion that they're doing to I-90 for freight, and now we have these foot ferries, these fast ferries to Kitsap County. It's opening up brand new neighborhoods where people are like, I could totally do that and maybe only go into the city 2 or 3 days a week. The city and just all the empty office space. What's the future?
Yeah, and there was a NYU professor who coined the phrase "urban doom loop" during COVID.
Oh, I don't like that.
No, but he walked that one back. He was on 60 Minutes a few weeks ago. But there's a reality here, and there's a quality of life issue, and quality of life can be a euphemism for a number of things, but let's just leave it at quality of life. And there are certain cities where quality of life was challenging pre-COVID and got a lot more challenging post-COVID. Whether it's Los Angeles, San Francisco, Oakland, and unfortunately Seattle was one of those. Now things I think have gotten incrementally better, but when people and companies have a choice and they say, what are the policies and what is the quality of life, especially given the fact that it is very expensive to do business here, that is going to factor into decision-making processes. And so look at the empty office buildings. I think, office is going to be challenged. It's a challenged asset class, especially, you've seen Amazon, who's certainly one of, if not the biggest employers in the area. They're moving people from downtown to the east side. Right. And so, I don't want to sit there and say there's an urban doom loop in Seattle. I'm not saying that. But when you combine certainly different politics than you have versus the east side and a lot of building and a lot of empty buildings, I think it's going to be a challenge on the
Well, here's my view of it. It's a silver lining is that's our runway for more jobs, even if the landlord doesn't like the price they're getting on the lease. It is an opportunity to fill that space. I don't think it's going to convert to residential. I think we'll see, Class C go into Class B to go into Class A. They're all going to upgrade. And, we still have seen so many Bay Area headquartered companies with satellite offices up here that are larger than their headquarters in the Bay Area. So, maybe this will just be an invitation for more recruiting and retention of jobs with multiple industries. And, to not have the buildings would be worse, in my opinion, because they're not going to get financed, right? So it could be 10 years before we see spec office buildings go back up. But for that, I feel maybe that we're more inclined to benefit with more job growth and more housing demand as a result of that, impending supply of office. How do you feel?
With the exception, I think it's Washington 1000 will deliver this year. And there's a few buildings being topped off in Bellevue. Once you get past those, there's really no new capacity coming. As I said earlier, it's a beautiful place to live, whether you're on the east side or whether you're on the Seattle side. It's a highly educated workforce. The tax rates, even if the capital gains rate stays where it is, the tax rates are certainly a heck of a lot less than in California. Right. So I think from a recruiting perspective, I would agree with you. The one thing I would just say is, this will be a little bit like turning a battleship. It will be evolutionary, not revolutionary. But I think you bring up some very good points.
Yeah, well, thank you, Jonathan. Appreciate you being here very much.
My pleasure, Dean.
Yeah, let's go address this
happy
crowd.
To do it.
Yeah, appreciate it.
Okay.
Okay, guys, until next time, this is Market Perspectives. I'm Dean Jones, and we will see you on the next episode. Please feel free to follow us on social media and send in your comments. We'll see you next time.